Europe's central bank cuts rates amidst looming Trump tariffs, a storm brewing in the Eurozone. The European Central Bank, ECB, has delivered a significant blow to already fragile economic confidence within the Eurozone, slashing its benchmark deposit rate by a quarter point to a mere 2.5%. This marks the second rate cut this year, a stark measure reflecting the growing anxieties surrounding the transatlantic trade war ignited by President Trump's escalating protectionist policies. The move comes as Europe braces for the potential devastation of a 25% tariff on all EU exports to the United States, mirroring similar punitive measures levied against Canada and Mexico. The ECB's decision, entirely in line with city economist predictions, underscores the mounting pressure on the Eurozone economy. The threat of widespread tariffs presents a considerable challenge, potentially triggering a domino effect across various sectors and crippling already sluggish growth. The imposition of these tariffs is not merely a hypothetical scenario. It looms large, casting a long shadow over the economic prospects of the 20-member currency union. The implications of this move extend far beyond a simple interest rate adjustment. It signals a proactive attempt by the ECB to stimulate economic activity and mitigate the potential fallout from the looming trade war. However, the effectiveness of this measure remains debatable, particularly considering the underlying structural weaknesses within several Eurozone economies. Lowering interest rates might encourage borrowing and investment, but it does little to address the fundamental issues, such as persistent high levels of public debt and the lack of substantial economic reforms in some member states. The immediate impact of the ECB's decision is already evident in the surge of borrowing costs in Germany, the Eurozone's economic powerhouse. This ripple effect has quickly spread, causing a sharp rise in Italian and French bond yields. This puts immense pressure on the governments in Paris and Rome to implement stringent austerity measures, potentially exacerbating existing social and political tensions. Balancing budgets in the face of economic uncertainty and rising borrowing costs presents a daunting challenge, demanding difficult and potentially unpopular choices. The situation is further complicated by the inherent complexities of the Eurozone itself. With varying levels of economic strength and debt burdens across member states, a one-size-fits-all approach like a blanket interest rate cut may not address the specific needs of each economy effectively. Some economists argue that the ECB's actions are merely a temporary band-aid, insufficient to address the fundamental structural challenges facing the Eurozone. The impending tariffs represent a direct challenge to the principles of free trade and global economic cooperation. The potential consequences are far-reaching, impacting not only the Eurozone but the global economy as a whole. The uncertainty surrounding the U.S. trade policies undermines investor confidence and hampers international trade flows, potentially leading to a slowdown in global growth. As the situation unfolds, the Eurozone finds itself navigating a treacherous path, caught between the need to stimulate economic growth and the constraints imposed by escalating trade tensions. The ECB's rate cut is a reactive measure, a testament to the gravity of the situation. The long-term consequences, however, remain uncertain, and the coming months will be crucial in determining the overall impact of this escalating trade conflict and the effectiveness of the ECB's response. The future of the Eurozone's economy hangs precariously in the balance, awaiting the final decision from the White House and its potential devastating consequences. This uncertain future underscores the urgent need for a diplomatic resolution to the trade dispute, ensuring stability and promoting growth for all parties involved. The international community watches with bated breath as this economic storm brews.